My name is Lee Adams. I'm Special Counsel with Owen Hodge Lawyers, and I've known Mariana Rodriguez for quite a while. Mariana and I have took brush shoulders with a number of matters over the last couple of years, and we thought it would be a good idea to get together and do a joint presentation on family trusts and business succession. Mariana's going to be looking at some tax issues that are relevant to this concept, and I'll be looking at mainly the legal issues, practical legal issues, I might say, things that you need to think about in a practical sense to make it work, which is what clients want. It's very easy to get sidetracked into the esoterics of it all, as professionals are inclined to do, but getting something that can actually work and fall within the bell curve, knowing that in 5 years' time you're not going to be running off tearing your hair out because there's been some legal change or some issue with tax law that makes the whole thing unworkable. So without further ado, I'll be talking for somewhere between 20 and 30 minutes, depending on how many questions there are and whether I get hoarse. And then Mariana will give her presentation shortly after that, and we'll all be out of here by 2 o'clock at the very latest. So without further ado, we'll start. And I'll be looking at the issue of family trusts and business succession, and of course, what are the things we're focusing on? Control. We want the control to move over from one person or group of people, often mother and father, or one family to another family. Costs in terms of time and money is also relevant. You want something that works, that's functional, that hopefully is easy to apply, and it's not going to take a whole heap of time or money for the people involved. CGT and stamp duty, those are the tax officer's main suite of armoury. Those are the two main taxes that I'll be focusing on, not in great detail, but just general concepts. So many of you may not realise, but it was the Knights of the Round Table and King George, King Richard the Lionheart started in the Crusades when everyone went over to the Middle East to fight the religious wars. Well, that's what they were called. You and I know it was really to open up trade routes to trading with Asia. But if you didn't occupy the land that you lived on, then it was forfeited to the Crown in England. So the knights and everyone else and all the warriors that went over there decided, of course, I'll have my family, my wife, my children, my parents live on the land that I'm occupying, that my family occupies, and they'll go off and fight all the crusades. And when I come back, they can leave and go back to their places, and hey, presto, I don't have my land forfeited to the Crown. So you had 4 elements of a trust a dozen years ago, and these are still 4 elements: trustee, the relatives, the trust property, the land where the warrior used to live, the beneficiaries, that's the warrior, and the trust obligations handed back to me when I return, if I return. Those are the 4 key concepts of what a trust is. And it's very frequently the case that the lawyers and accountants will say, well, the easiest is sometimes the best, often the best. Not always, it's certainly worth looking at. Changing the shareholders of the corporate trustee. It's cheapest, the shares $1 each or whatever. Shareholders control the board usually. Check the constitution, maybe they don't. And of course, no duty since 1 July 2016. Is that really the case? Well, it's not quite really the case. It's mostly the case, but if you've got a trust that owns land, then you might have a problem. And lawyers and accountants will look at a relevant acquisition in a landholder, resulting in shareholding increasing up to or beyond 50%. That's what we look at. And the nuts and bolts of it is, if the corporate trustee is a beneficiary, so the same company is also a beneficiary of the trust, and the trust holds land in New South Wales, and the land is worth at least $2 million, then the corporate trustee is taken to be a landholder. And so if the transfer results in a person and their associates, and of course this is a friendly Deputy Commissioner of Taxation, associates is widely defined, includes companies and trusts and relatives and what have you. So if the transfer results in a person and their associates holding 50% or more of the shares, then the transfer of the shares is a relevant acquisition, and you've got duty up to 5%. Your $1 share, 49 to 50 or 49 to 51%, all of a sudden you've got 5% duty on $2 million. How did that happen? It's this legislation. So, of course, the Chief Commissioner in his wisdom and kindness has a clause, a provision in the Duties Act that says he has a discretion to grant a full or partial exemption where it is not just or reasonable to impose landholder duty. That's been used once since landholder duty was so I think it was 2009 when you first had this concept of landholder duty. So there's been one case where the Chief Commissioner in fact did exercise his discretion and not impose it. So, you know, ask yourself if you're lucky if you want to use that section. But of course, the simple answer is, before you change the shareholding, amend your trustee. Preclude the corporate trustee from being a beneficiary before the transfer or issue of shares. So, and that's of course why we use lawyers and sea professionals, because we just don't know what we don't know. And that would solve the problems. Okay, what about changing trustees? We've got Bob and Bernadette are trustees, and they are beneficiaries, trustees and beneficiaries of the family trust. And they want to, this is a good reason not to have personal individuals as trustees of your family trust. It's just not a good idea for a number of reasons, and this is one of them. So Bob and Bernadette, they're trustees, they turned 72, they're both 72, the beneficiaries, they want to retire. Their son James is a company, he's switched on, he wants to use a corporate trustee. The only problem is Section 54 of the Duties Act says that if Bob and Bernadette continue as beneficiaries, ad valorem duty is imposed on the change of trustees. That's what the section says. So if you're if you've got a corporate beneficiary and you're a trustee, and you then continue to, corporate trustee and a beneficiary, and you continue to be a beneficiary, but you change corporate trustees, you'd still have the same problem. So again, amend the trust deed so Bob and Bernadette cannot be beneficiaries under the trust, or remove them as beneficiaries altogether. But there's always a but. The Commissioner requires the amendments to be irrevocable. So lawyers who aren't familiar with this area go, there you go, Mr. Commissioner, I amended it. And the corporate trustee is no longer a beneficiary, but if the deed of amendment isn't stated to be irrevocable, so you can't go back the next day and then reappoint them as beneficiaries, then there's a real problem. And of course, we've got this concept of trust splitting. Now, the accountants in the room will know that this is history, but for those who aren't accountants, simply put, for a number of years now, certainly since Clark's case in 2011, pardon me, what was very common was that you'd split the trust. You'd still have the same trustee, same beneficiary, same trust document, but you'd have one, the continuing trustee being a trustee of these assets over here, and you'd appoint another trustee to be a trustee of these assets over here, which happen to be the majority. You know, if you're thinking of family succession, the continuing trustee would run the $15 in the savings account for mother and father, and then the new trustee would run the bulk of be the trustee of the bulk of the assets of the trust. And those controlling the new trustee, pardon me, those controlling the new trustee would typically be the children or the child of the parents. But of course, this TD, Tax Determination 2018, Draft Tax Determination number 3, 2018, says that that's going to give rise to CGT event E1. Why? Because we say so. because new personal obligations and new rights have been annexed to the property. Says who? Says the ATO. On what basis? Are there any cases on this? No. In fact, the cases that are relevant to this, the tax office says aren't relevant, and so it's a bit of, there's no legislation, and there's going to be a few people around who are going to be test cases for that tax determination, I suspect. So the long and short of it is, if you're thinking of something that you want to have work down the track, I wouldn't recommend a trust really at this point in time. Changing the beneficiaries. Up till Clark's case in 2011, which is the full court of the federal court, and the High Court said, we don't want to hear this, I'm not going to hear an appeal. You're not given leave to appeal. And they thought the full court of the federal court had pretty much answered everything. There's a couple of things which we'll find out in a second that they didn't consider, but the High Court didn't want to bar it, so this is the best we've got at the moment. If all four elements of a trust continue, this basically summarises the federal court and the federal, full federal court. All four elements of a trust continue over time. Remember, we have the four elements: trust, property, beneficiary, and duties. Even if any or all of those elements change from time to time, then no new trust is created. Otherwise, you've got duty at 5.5% because it will be considered a resettlement. And so that's simplified things, but it hasn't solved everything. This is the tax determination that the ATO put out the next year in 2012, giving us the tax officer's view and its interpretation of Clark's case. And pretty much it said, yes, you can change benefit. It gave 4 examples. One example was where beneficiaries were removed and added. If they are removed and added in accordance with the power of amendment under the trust deed. You just can't sort of have a scribble on a piece of paper and unless that's what the trust deed says, but usually there's a deed, it provides for a deed of amendment, sometimes it provides for with the consent of the appointor, if there is an appointor, and sometimes it can be by instrument or written determination. But whatever the trust deed provides, that's how you've got to do it. That's the valid means of amending a trust deed. It then considers, apologies for these arrows are all out of kilter, settled assets on a new trust. Pardon me. The fourth example that the TD 2012/21 gave was where you're a trustee of a family trust and say the beneficiaries are Mara Parkettle and John and Mary, and the trustee makes a declaration that he's, he or she or the company is holding a particular asset for Mary. Now that would be considered a settlement of an asset on a new trust, and the Charter of Rights, this concept has gone back 25 years, this concept of Charter of Rights. That house that Mary now is being held by the trustee for Mary, it's no longer being held by the trust for the beneficiaries generally, subject to the trustee's discretion. It's being held for Mary herself. It might be a bare trust, for example, so you can call for that house at any time. So if it's a settlement of an asset on a new trust, the Charter of Rights has changed. It's basically torpedoed the guts of the trust, and the tax office will say that that is a new trust, and so duty on the declaration of trust applies. Then there's this concept of substratum, which has been floating around since 1969. And the substratum, and this is an element that the full federal court didn't talk about, but if you've got you can change beneficiaries. The Clark's case says you can change beneficiaries. This tax determination says you can change beneficiaries. So we've got a family trust for the Smith family, the spouses of the Smith family and cousins and whoever else. What about if you then have a look at the way the trust deed can be amended? Clause 15 says variation of trust, you've got to do all these things, you do all those things, You say everybody in the Smith family, nobody of the Smith family are beneficiaries anymore. It's now for the Jones family, who are totally unrelated to the Smith family, a totally different set of beneficiaries. If you have a look at all the cases on substrata, that really is effectively a new trust. It's nothing to do with the Smith family. It's totally devoid of all the purposes that might have been the settlor may have wanted to create the trust for, which was for the Smith family. And so I think you still run a big risk that if you make those sort of fundamental changes to a trust, you're going to run into problems. So pointor, it's de rigueur to have an appointor these days. The pointor is that's the airbag going off before the head-on, where the trustee is not doing their job. The trustee can have problems. They can become insolvent. They can become incapable by disease or accident, and they can. All sorts of things can happen to trustees, even corporate trustees. So the appointer is a very good thing to have, and they have the power to sack and appoint trustees. But you do, as I've shown in the slide, have to follow the power of appointment and removal exactly. Now, if you have a look at this example down here, the relevant clause says a power with the prior consent of the appointer. So the trustee has a power with the prior consent of the appointor to revoke, add to, or vary all or any of the trusts heretofore provided. When you have a look at that, the very first thing that comes to my mind is, well, you'd want to have the prior written consent of the appointor, because you may not be around to verify that in fact you've spoken to the appointor, or the appointor may not be around, so you get the prior written consent, but that's a minor point in those circumstances, to vary all or any of the trusts. This was in McCandy's case in 2015, and the court in McCandy's case said the trust provisions, which is clause 3, 8, 15 and 12 or whatever, didn't include the power to appoint and remove trustees. The court said that's not part of the trust's provisions. So that power to amend didn't cover changing the appointor. So the appointor wasn't changed, and so the appointment of the new trustee by the new appointor was invalid. So the whole thing just collapsed. It was a terrible mess in terms of time and money and legal fees for everyone involved. It was an absolute disaster. But compare the next phrase. So you've got a power with a prior consent of the appointer to revoke, add to, or vary, which is nice and broad, and pretty much considers everything, doesn't it? Of all or any of the trusts, powers, and all provisions and clauses and schedules of this trustee. There's been cases where, this is a Schedule A or an Extra B. Is that part of the trustee? Don't know. If you include it in this power of appointment, you don't have, there's no doubt you've got power to amend them. So little things like this is what lawyers get a buzz out of. Vesting date. People don't understand the vesting date. The vesting date's when the trust ends. And people talk about the Perpetuities Act. Perpetuities Act operates after the 31st of October 1984. Okay? So we had a trust deed presented to us. It was dated 1980. And a lot of deeds were put into place in the early 1980s, 5 years before CGT. Nobody knew, the accountants and lawyers, nobody had a really good idea of what capital gains tax was going to be like, so everyone was throwing money into family trusts like it was going out of style. And and this was created at that time, and so it was a 40-year perpetuity period for reasons unknown. This 1980s trust deed was going to vest in 2020. So we're doing estate planning for this family, and I said, well, what are we going to do? You know, the trust vests, and there's $6 million in the trust, and we've got second and third generations, and we don't want to pay all this capital gains tax. We'll have to get another 40 years, they said to me. Well, I said, well, hold on, you're prior to the perpetuity. You could have 40 years if you wanted it, but you might be able to squeeze more out of it because you're not bound by the Perpetuities Act. And the law before the Perpetuities Act was, quote, a life in being plus 21 years. So any person, Ian or Mariana, that's a life in being. When you die at 21 years, I would say 21 years after the date of death of Ian Jagger, or 21 years after the date of death of Mariana von Lucan, and that would be the perpetuity period. Then some smart lawyer, sometime after King George VI died, wrote that clause in his agreement, in the trust deed, the perpetuity period being 21 years after the death of the last survivor of the descendants of King George VI living at the date of this deed. And it was attacked because it was void for uncertainty and who knows who they are, and it was all too hard. But, you know, when you think about it, it wouldn't be too hard to figure out, you know, you've got Queen Elizabeth, of course, and her sister and her relatives. And you have, Peter Phillips was born on the 15th of November 1977, first and only son of Princess Anne. So if you've got a trustee dated the 16th of November 1977, that clause has worked pretty well. Peter Phillips has probably got a good chance of living to 80. 21 years on 80 is, what, 101 years? So you've extended the perpetuity period by 21 years, from 80 years to 21 years, most likely, if you use the old clause rather than the new clause, which is what we did. Distributions to corporate beneficiaries. When the trustee is a shareholder of the corporate beneficiary. So if there's a company which is a beneficiary and the trustee is a shareholder or an associate of a shareholder of the corporate beneficiary. So distributions to the corporate beneficiary can be treated as unfranked dividends, unless you've got the 7-year loan agreement or 25 years with a mortgage. And of course, it's again first lesson for the accountants in the room, so I apologise for that. But you know, up till fairly recently, people would say, "Oh, that's okay. I'm not going to make any distribution. I'll make a declaration, but I'll keep the money, because if I make a declaration and distribute the money to the corporate beneficiary, they're going to be paying tax at 27.5%, which is a lot better than 47% tax for the trustee if the funds remain in the trust. But of course, this is now considered an unpaid present entitlement, UPE. And so, again, Division 7A will apply that unless you comply with Division 7A. So you need to be careful of distributions to corporate beneficiaries and comply with Division 7A, otherwise it will run aground. When you're dealing with families, lots of parents give advances to their children or their family, and we all know that it's a loan. I've said to John, it's a loan. I've said to him 5 times, it's a loan. I've said to his wife, this is a loan of $500,000 and I want it back when I want it back. But guess what, you know, people sort of forget or weren't listening, we sort of hear what we want to hear. And we trust each other. I don't need to reduce this thing to writing. Go and see a lawyer. And say, I don't know how many times people have come to me and said, oh look, you know, he was my best man, but now he's my worst enemy. Yeah, it happens. So, and I say, look, you wouldn't be talking to them if you didn't trust them. But it's everything to do with communication. Write it down. Put the deed away or the document, whatever it is. You don't have to look at it, just as long as you know where to find it. And hopefully you'll never need to look at it. But if you do need to look at it, you'll find out exactly what was agreed to. So if you don't write it down, another very good reason for reducing a loan to writing is that it's considered under law to be a loan repayable at call. So how long have you got to get your money back? 6 years. What happens if your son divorces? Okay, you've got a loan repayable at call. He gets a divorce in 7 years. You want to get your money back? You just contributed $500,000 to the family assets. Thanks for coming. So yeah, the deed of loan is not such a bad idea, even if there's no interest. So unless it's got all the other attributes of a loan, and you can show that it was paid, received, that's all good. Winding up a corporate trustee. So it's just 105, so I'll finish shortly. So liability of directors. This is a case in relation to a very recent case this year. An auditor of a self-managed super fund. I know we're talking about family trust, but self-managed super fund is a trust, so I'm close. But it's a very interesting case. Auditor failing to give warning of risk of loss regarding a self-managed super fund investment. The member director was held 10% liable. Dr. Bear, the case was Camembert, C-A-M, new word, A-N-D, new word, B-E-A-R, proprietary limited, very clever. Dr. Bear lent money to a close friend. Guess what? The assets were identified as cash, but actually it was unsecured loans. Eventually, Dr. Bear wanted his money back. He couldn't get it back. Wasn't there. And the auditors were held 90% liable for the loss because they should have identified that who was this Mr. Lewis and his company, and what sort of security you got? None. Why are you lending it to him? Oh, he's a friend of mine. Yeah, the auditor never identified that risk, never wrote the loan down, never said you need to look at this very carefully because I don't think it's really worth the money that you've invested. But look what the court said. Even a person with Dr. Bear's lack of financial sophistication should reasonably have considered the prudence of depositing significant amounts of money with Mr. Lewis's company. So you can't hide behind, your professional advisors all the time. The law does expect a certain degree of common sense from the people that appear before them. Winding up a corporate trustee. We all know who a director is. You can be an active director. I've got my name up in the ASIC records. Mentioned de facto director to an accountant called Mr. Austin in 1998. He probably throttled you. He got so involved with his company's, with his clients' affairs that the court held him to be a de facto director, even though he wasn't his name was never on any meeting of the director. He's always there at the director meetings, but his name was never not present, never signed anything, never chairman. But he was basically running that. He moved from being an advisor to the point where he's actually carrying on the duties of a director responsible for the affairs of his client company. And then you've got the shadow director. That's a person in accordance with whose directions the directors are accustomed to act. Mary, I want you to do this now. So Uncle Fred tells his children how to run the company. Uncle Fred is a shadow director. They obey him. No one dare trespass upon the directions of our uncle. So be careful of a shadow director as well. And this has ramifications for insolvent trading. People misunderstand insolvent trading. If you have a suspicion, first of all, when is the debt incurred? If you're signing up a commercial lease, the debt is not incurred every month when you pay the rent. The debt's incurred on the date of that lease agreement. So if you've got feelings like, I just got a hunch that this isn't such a good idea, I got a bad feeling about this, something that puts you on inquiry but you don't have sufficient proof, but you've just got this gut feeling, that's suspicion. And the court says if you're signing off incurring debts as a director of the company, when you suspect or should have suspected, then you can be made personally liable for the debt. Should have suspected. So yeah, that's means that the old-fashioned defence of I wasn't there, I didn't know, I left it all to my husband or wife. That's not going to wash. Hasn't washed since 1993. And then, of course, indemnifying the commissioner of certain payments is set aside. So, gosh, this family trust has had it. The landscape has failed. It's changed. Trust is failing. I'm going to pay out the commissioner and all the other creditors, including my family members, will just have to wear it. They're unsecured creditors. I just don't want to get a bad name with the tax office. So you pay out the commissioner. And it's within 6 months of the liquidation of the trustee company. So it's a preference, and the liquidator can claw back preferences, and the commissioner will very gladly comply with the law and pay all the money back. Under 588 FGA of the Corporations Act, if the Commissioner has to pay the money back, guess who he looks to get it be repaid? The directors. So beware of that one. And then transactions to defeat creditors. So this is a typical example where a director sells his own assets, puts them in the family trust to defeat his own personal creditors. And of course the assets can be clawed back and there is no limitation. You want to defeat creditors, and this includes future creditors, by the way. You might say, how can anybody even get around this? Everyone's got future creditors. But that's a sort of discussion on its own. So you put money into the family trust to defeat creditors. There's no limitation period. You can be let's say, child, a son or a daughter of whatever age, and suddenly find that the trust has to refund money to your 75 or 80-year-old father or mother who thought they were being really clever 15 years ago. In Donnelly's case, the clawback was 14 years, but there is no limitation period. So you sort of really need to ask Mum and Dad, now, what have you been doing the last sort of couple of decades? You said, I remember something you said there back in the 1990s, there was some problem and you had to, put some money in the trust urgently. What was all that about? It's nice to know in advance. So, winding up a corporate trustee, there's a right of indemnity out of assets of the trust. That's judge-made law. There's an equitable charge. So the trustee gets sued, they've got a right to take money out of the trust and pay. Liquidators and bankruptcy trustees have that right. It passes to them on liquidation or bankruptcy. But misconduct or unauthorised acts of a trustee destroy the right of indemnity. So any of these provisions, paying preferences, transfers to defeat creditors of directors, insolvent trading, seems to me they all fall under the misconduct or unauthorised acts banner. So you've got no right of indemnity. And what happens when you don't have a right of indemnity? 197 comes to the rescue, and there's personal liabilities on the corporate trustees directors. So it's always a good idea for the children of people who are families that are sort of, I use the word inheriting the assets, but taking over control of them might be a better expression. To make a good inquiry of what their parents have been up to over the last 10 or 20 years, and have a look at those issues, just because none of us like to be, have surprises, and in some instances those surprises could end up destroying the whole family business.
Trusts are a complex and difficult creature or beast, whatever you want to call them, and they exist at any point in time. So it's always good to understand when you're putting clients into a trust, what are the issues? And these covered off some legal issues and also some tax issues. Now we did agree, so it doesn't look like we weren't coordinating our efforts together. I'm going to touch on vesting rules because there's a tax ruling that's come out. It'll be short and to the point. Family trust elections and interposed entity elections when you've got a deceased test individual. Specifically, New South Wales surcharges, how do you reduce the liability of it all, and dealing with loans in trusts, pre and post death, and corporate versus having a corporate structure versus a trust when you're building wealth for your clients or for yourself. What are the advantages, disadvantages? Have you thought about it? So if I go straight in. So normally I'm used to having a computer in front of me so I can see the screen and look at you, but I'm going to be looking over here as well. Trust vesting date. So as I think it's worth pointing out 100 times that as accountants, so as an accounting firm, we do tax here, but we're not lawyers, so we can't change a deed or anything. We go to Lee or some other referring lawyer to do that. But if a client comes to us and they already have a trust set up, we have to look at when is the actual vesting date. There's no extension of time if it's already vested. And that's what this particular rule in TR 2018-6, it's just been finalised recently. It was in draft and for about a year or so, and it's been finalised. So this really just spells out what the ATO's view is. Rulings, you know, they're not binding, but again, try to go against it and you have to put your reasoning behind it. So you can't extend it once it's vested. Even though there's more time left on the deed, if the timing of the vesting date has gone, it's gone. What do you do when it has vested? And I'll go through that. On vesting, if there's no transfer of property and you're just really doing distributions and so on, well, there's no A1 event, so there's no CGT event. You're not sold anything. That doesn't happen. And that's what the ATO confirmed. And it's likely E5 event, absolute entitlement, won't happen either. There won't be a CGT event, and I'll go through that in a minute. And also, you need to have a valid amendment to the trust deed. So if you validly amend your deed, when it's not out of time, but before that, you have to make sure there's a clause in the deed that allows you to do that. And again, it's not yourselves, it's the lawyers looking at it, but it's always remember to read the deed. Very important. And that's, you know, if you're doing estate planning, that's one thing you'll always have to look at the deed if there's already trust set up. And deeds, when you set up a trust, they are state-based, the rules. So they all have different vesting dates, pre-perpetuity rules. And as Lee's already alluded to, does the deed have the power for you to extend it? Some deeds don't specify it. So then you have to go to your trusted lawyer and say, well, what do we do here? Do we go to the courts and get an extension? If it hasn't vested already. So this is with pre-vesting. So apply to the courts. I think if it doesn't tell you in the deed, check with your lawyer and apply to the courts. For New South Wales, statutory period of 8 years, Lee's already covered that. And pre that day, common law applies, which Lee has covered. So again, read the deed. Post-vesting. So what's happened is that the trust has vested, maybe unknown to yourselves, maybe known, but in the case that it's unknown, if there's no, and you've just gone and administered the trust as usual, then what do you do? And one of the things is that you can't extend the deed, but it doesn't mean necessarily that you have, it doesn't necessarily mean that you have a capital gains event. Now, you have to read the deed because you have to make sure that does the deed allow you or to actually keep going. So some deeds are actually very unusual, but some deeds will say that the trust deed will terminate. So the actual trust will terminate at that vesting date. Very unusual. And then at that point, likely you will have a CGT event. But in most cases, if the deed allows you to it, then you would continue the trust as usual. If you haven't sold any assets, likely you'll have the takers in default, there's residual beneficiaries that are outlined in the deed, which will say that, and maybe there's more than one, there's probably two, so you don't necessarily become absolutely entitled. So therefore, a capital gains under E5 doesn't necessarily happen, and that is being outlined in another ruling, which has been drafted for 14 years. I don't know why. They probably can't be bothered finalising it. But what happens when it does vest? The trust becomes, the discretion becomes fixed, basically. And you can only really distribute to those beneficiaries that are the takers. They're the residual beneficiaries, if you like, and the deed will tell you. So it may be necessary 2 people. So you can distribute to them all you like and keep the trust going that way, and it runs like a fixed trust. The trustee doesn't have the discretion anymore to distribute to other beneficiaries. So if, say, somewhere during the middle of the year you come across a deed, it wasn't yours, not your client, right? It's come across to you by someone else, and you realise in that particular year the trust actually has vested. What they allow you to do is to actually, pre-vesting is distribute at the trustee's discretion, and post vesting, you have to distribute to the actual beneficiaries that are going to be part of the fixed trust. So there are ways around it. So it can continue the trust, it doesn't necessarily end at that point. And you don't necessarily have a capital gains event. So what I want to say here, it really snippets of different areas, because as you know, they are complex, and it really depends on the facts. It so much depends on your clients, the facts, and what the actual arrangement they have. Why do we make family trust elections and interpose any elections? Just to recap and refresh, it's really to avoid the complexity of the trust loss rules, simplify tracing when you've got losses and you want to use them, continuity of ownership test, lowering of franking credits, and then the ultimate, under the small business restructure, ultimate ownership. So that's why we make those family trust elections. But I think what we need to do is, we need to consider the consequences of getting it wrong as well. So do we really need a family trust election in the beginning? So sometimes we're conditioned to go, okay, we set up trust, let's make a family trust election, boom, boom, on we go. Then what happens years later, that person, the test individual, passes. And then it becomes very complicated, because it's, who do you want to distribute to? You want to distribute to a new trust. They haven't got necessarily the same test individual. How do you go about doing that? So it creates issues. So that's why I say, have a look, make sure that you need a family trust election before you do it. Consequence of getting it wrong is you have the family trust distribution tax, which is your maximum tax rate, which the trustee will actually pay that at 47 cents in the dollar. So that's what happens if you get it wrong. So that's why I say consider if you need the family trust election. The test individual needs to be alive to make a family trust election. It sounds kind of funny, doesn't it? But say, for example, they are distributing to another trust, hasn't been set up, it's going to be new, and that particular trust that's making the distributions, the family trust election has been made for the test individual that's passed. That he's already made the election, but for the new trust, can't be the same person. So what do you do there? Well, there is possible to make distributions. You can have one of these interposed entity elections. That's what they're there for. They're saying you make the election, and who makes it? Not the trust making the distribution, but the trust or company receiving the distributions. And they have to make sure they pass a family control test. So try to keep all the wealth in one family group. And that has its limitations. So therefore, I think it's important to follow the rules and the legislation when you are going down that track of making any interposed, or you're looking at making distribution to a trust or company. Do I need, if it's a trust, is it the same test individual? No, yes. If it isn't, is it a family member? Yes. Can I make an interposed any election? Yes. Go ahead and do it. And the death of the test individual, very morbid, isn't it? Death of the test individual doesn't prevent you from making an interposed entity election. It's separate. Family trust election interposed. Another thing that, Lee, I don't know if you've come across this, consider trust banking strategy, where if you're doing estate planning, I haven't been involved in this, but I don't know if anyone in the room has, is to basically set up a few discretionary trusts with the person doing the succession planning, so the test individual, and potentially do the family trust elections for those discretionary trusts that you've set up. So you're banking them, so you're putting them in the bank for later to use. So if the individual passes, you can still use them. But has anyone seen that? Used that strategy? No. Okay. We talked about the first point. Another thing to consider, again, is when you're making distributions to another trust, what's the vesting date of that other trust? When I came across this, I was quite interested in it because normally you go, okay, here's the distribution. Yep, they've got it. They're the same family trust, same test individual. We don't need an interposed an election. Fine, we go. But do they have the same life, the vesting time? So does the second trust live longer, if you like, than the first trust? And if it does, then that breaches that perpetuity, because that's the whole point of trust, is they can't live any longer than 80 years, assuming I'm with the new rules, when the perpetuity rules came in. But they also make a concession. There's, if the trust allows it, there's a bit of a wait and see rule. So you don't have to necessarily, if you're setting up a new trust to make distributions from the original trust to it, you either make the vesting date before or on the same day as the first trust, or another is do nothing, wait and see, but make sure that when you're looking, as you normally assessing your clients, make sure that you're, that trust, the first trust won't vest before the other one. So that, and so you need to have a look at the clauses in the trustee. That's what I'm saying. It's all very quite complex. When it's somebody, I know as an accountant, you go, oh, you have a family trust election, off you go. But they're quite complex rules. So something else to watch out for is the New South Wales surcharge rules, which we've come across. So when drafting the deed, or buying it off the shelf, may cause, you may need to consider these New South Wales duty surcharge and land tax surcharge rules that apply. This is to New South Wales for New South Wales residential land. Different rules for different states. So I'm just going to point out New South Wales. I know I was setting one up for Queensland, and these rules didn't apply because I had a foreign resident, so it was quite good. And this applies more, it's more of an issue where the beneficiary there might be a foreign person in an Australian dad trustee that could trigger these surcharges. So if you think you set up a trust and you think of all, you know, the test individual, the family, normally they're all Australian residents, so it shouldn't be a problem, right? But then you've got to ask yourself, say I've got a daughter or a son that live overseas, are they considered a non-resident? And, you know, potentially then, do I get these extra duties, additional duties applied? And who's going to apply them? Like, is the OSI going to know? But potentially, yes, if they come looking. I think the reality of G009, it tells you what a foreign person is and goes through really in-depth description, and if you've got hours, you can have a look at it. But effectively, it's not a person that's a citizen. So if my child, I don't have children, but if I did have one, was a citizen of Australia and went overseas, not necessarily considered a non-resident or foreign person, I should say, for these purposes. But the safe way, what you can do, G10 tells you it imposes a duty. Safe way, what you can do is to basically, in your deed, potentially put a clause in the deed. Now, I know when you buy them off the shelf, they don't have these clauses currently, unless something's changed. But you could exclude foreign persons in the deed. You just got to be very careful if you do that, though, because it depends what the deed has. If it has, and this you might do it for the purposes of property, but it might have other shares, and it might have foreign shares, and there might be distributions that you want to flow through to that foreign non-resident. So you need to consider what other assets this trust has before you go and make the exclusion. And if the commissioner in the OSR, if they do assess you, you do have a 6-month period to amend the deed, to ask for a discretion as well. So you don't do it by asking them. So I think you just have to ask the question. We went through the exercise of going through all our deeds and looking at them. Do we need to amend any of them? So you might need to go through. You may have already thought about it. And if you have, great. I'm just telling you something you already know. Lee's already gone through this, dealing with loans. These are just some quick slides, so it won't be too long. Dealing with loans in trust, so pre and post debt. Again, have a think about what happens if the trust owes money to an individual. So how did that arise? The trust has made money or had a money flow into it. It distributed to a particular individual, and I'm talking individual here, but we didn't pass the money across. We've just said, here you go, we'll owe you the money. But you pay tax on it, by the way. So that's great. So we may have flowed a little bit of money so they pay the tax, but that's fine because the individual was beneficiary, discretionary trust, but they want to accumulate wealth in the trust, no problem. But we're coming down to estate planning and we're thinking, okay, I've got this loan, and Lee touched on some issues, and what I was going to touch on here was more about, do we forgive it, do we gift it, do we leave it for the estate to figure it out? And so some tax issues to think about. A forgiveness is possible from a tax perspective, but that means then that person will never get the money. They were never going to take it out anyway before death, potentially. Post-death, they were never going to get it. But if you left it in the estate, somebody else may be entitled to it, whoever that may be. But if you did forgive it, that means it's extinguished. These Div 7A should not apply as the individual is already included in their assessable income. So no issue there. If you've heard of the debt forgiveness rules, the Div 245, they don't apply to UPE. So there has been some private rulings that say that it's not a debt. So we're okay there. But it could be different with a company. So individual, less of an issue. Company, potentially you've got a Div 7A issue. Not necessarily a 245, but from a different section. Could you gift it? Yeah, you can gift it, which is interesting. It could trigger an A1 event, but in the end I think you get a net result of no capital gains. And it goes through the process there of how that comes about. Giving the donor effectively a reduction of capital gain and the recipient the market value of the loan. So gifting, it means you've moved it across to another individual. You might not necessarily give them cash, but you've done it with pre. Or just leave it and the estate can deal with it. And I think I just want to throw out there, I guess, something we've been thinking about in our firm is, do you set up corporates or do you set up a trust for accumulation of wealth? Now, I would agree with you if you have property, probably company isn't the best idea because you lose your 50% discount. But if you look at the way companies are headed, there's already a reduction in the company tax rate. Admittedly, it's for companies with turnover under 50 million, but could potentially any entities that have a passive income, which was what we're probably talking about, could the tax rate be going down for them in the future? Well, certainly, currently companies at 30 cents in the dollar. If they have passive income, they stay at 30 cents in the dollar. If they're carrying on a business and they're under 50 million, they're 27.5, and that'll go down to 25. Now, if you think about the capital gains tax after discount, what you're paying 24 something. So it's not much different, but we're talking still about 30 cents in the dollar. Now, franking credits can be passed on, so there's a benefit there. It's possible to accumulate. You just sit it in the company, it just flows through. You don't have to worry about every year, do I make an election, who am I going to send it to, did I make that distribution statement, etc. You know, ease of doing business. It potentially can be something to think about if the wealth of the individual or the family might be that 55 million or more. Usually, because why we say that is, they're not necessarily probably using that money. They don't need the income from that money all the time, so they can allow it to accumulate. And if you did want it, you just distribute it. And you could have a trust, being a shareholder, and distribute it out that way. It does control it a bit more. And why it was raised, Peter Bembrick, one of my other partners here, did an article, was in an article recently. I think it Labor's proposal to the changes to beneficiaries being taxed at fixed rate of 30 cents and 30% might make it more appealing. Now, that was announced a year ago by Labor, and it's only if Labor comes in and should they bring it out. So there's a lot of ifs and buts and who knows. Peter, you don't think there's any movement on that? No.
But just to your point, Marianne's pointed out that what we were looking at our structure, and one of the other partners there, we had a client who we were talking about, like, took about $40 million of wealth, family wealth, so he did generation of wealth, so that's certainly where we consider that to the levels we're talking about here, but yeah, up to really large amounts of wealth. Yeah. And Neil's advice in that case certainly was that the amounts involved were quite significant. So a corporate structure in that situation made a lot of sense. Yeah. Yeah, so just you need to look at what assets, what the advantages are, what the disadvantages are. So loss of 50% discount, well, we wouldn't necessarily say property put in there, but could be. Share, and also I think with shareholders fixed, yeah, there's a fixed entitlement there. You go, unless you go to a discretionary trust, as I was saying. There's always going to be a top-up tax if you're paying, but you can control it depending who you pay.
because they've got the franking credits there. So really that's really all I was going to cover. Just wanted to highlight a few points. It's very hard, I think, to cover everything and all the different scenarios. So I don't know if I've answered any questions that you may have come here looking for. But certainly if you've got any questions now, I think Lee and I would be happy to answer them. No? Means we covered all your queries. Fantastic. Well, thank you for coming, and I hope the presentation has been useful. Did you want to say anything, Lee?
No, good.
No, that's right. So, okay, yeah. So that's probably the conclusion of our presentation. Happy to take any questions. Lee and I will be here if you don't want to ask the group. Please help yourself to the lunch boxes. This is our first time trialling them. I don't know if everyone liked them. There's a variety of things in there, so it's like a lunch box. You go to school and it's very fascinating. I don't know if you do have all that when you went to school, but I didn't. But it was easy to use and put on your lap and everything. So thank you once again.